My name's Rob Williams. I'm the Chief Investment Strategist for Sage Advisory, longtime attendee of this conference. We're an independently owned asset manager based in Austin, Texas. Manage about $24 billion at this time. Primary business lines are core fixed income, SMA, and then also ETF strategies, multi-asset ETF-based strategies. Those are two lines. I guess people know us for kind of bringing an institutional thought process to an ETF portfolio. We're actually known as one of the pioneers in the managed ETF space. We really started using ETFs in fixed income portfolios as far back as 1999. And now fast forward where we are today, we have about $2 billion in assets just on the ETF side and manage portfolios from all fixed income to all equity and balanced models in between. So we're a bit cautious. We're fully invested. On the fixed income side, we're short duration. We think the way you want to think about it is really have a higher quality portfolio this year, meaning maybe have more fixed income. If you're in a balanced allocation, maybe have a little extra fixed income than you had last year in conjunction to how much equities you had. In fixed income, don't reach too much for yield, stay high quality. Yields are good across the board in fixed income, both low quality and high quality. Not a good time to reach for yield, so limit the high yield exposure. We're still a little bit U.S. focused, but stay quality in your allocation. Try and avoid the overcrowded parts of the market like growth, momentum kind of sectors of the market that have really run. I know diversification didn't help you last year. I think it's going to help this year. I've been talking a lot about fixed income. So for this year, we do think fixed income is a big opportunity. We think equities have given you a gift with a big rally, a big year last year, a good start to the year. I think it's good to have some duration, some bond duration in the portfolio, right? People are worried about yields still. They're going up near term, but the big picture, they're going to be going down for the year. Yields are actually higher than when the Fed stopped raising interest rates. So that is also a gift. So the window is open to extend duration and get some more fixed income in your portfolio. Don't think about rates in the short term. Think about rates in the medium term and where they're heading for the year. That's probably the biggest opportunity in fixed income. We love securitized products like MBS in particular. We think you can tamp down the credit risk, which is the dangerous part of fixed income, and have more securitized assets like MBS. It's giving you a gift because MBS is yielding the same as corporate bonds, and it's a much higher quality. In equity, I already mentioned high quality is where you should probably sit. But that said, we do like the U.S. over Europe. We like the U.S. over emerging markets because we think the data picture is higher quality. We're going to get better kind of results economically here probably. There's a few exceptions. We like Japan. Japan is attractive to us because they still have some policy support behind them. They do have some economic upside and the valuations are attractive. So there's opportunities, but overall we're being pretty cautious. Liquidity risk, I think, is something we might face this year. I think, and it's written around and people realize that that's a risk, but I don't think people fully recognize the luxury of all the excess liquidity the equity markets and risk markets have enjoyed over the last 8 or 10 years, right? It's going to be very difficult. The Fed has to managing this cycle. They're going to have to managing shrinking their balance sheet for a little bit longer. There's a ton of treasury issuance that has to hit the market. There's some liquidity concerns with the banks and commercial real estate and things like that. So I think liquidity risk is something that could derail an equity rally very quickly. And I don't think people fully appreciate, where we are in the cycle. It's going to be very difficult to navigate it for the rest of the cycle here. We've come to this every year. It's a great chance to meet clients of we're the client, which is nice, and we want to do our due diligence on some of the ETF providers, but there's also people that are clients of ours that are here, and we can go out to lunch with them and see people that we actually do business with. Our strategies are on their platform, and we can go out and have some fun at night and go out to dinners and things like that. So we love it.